Hey guys, welcome back to another episode, another tutorial from Everything Business. If it's your first time, thank you for coming, and if you are a regular subscriber, then thank you for always coming back. All right, today we're going to be talking about partnership accounts. All right, so let's get right into it. Now, what is a partnership? So, a partnership is a business that is owned and operated by 2 to 20 persons. Now, partners share the risks involved in establishing and operating a business. It is important for you to pay attention to the word share because that word is going to come up a lot. All right. Partners also share profit and losses of the business. Some partners may choose to work in the business, right, and receive a salary, and you call those partners active partners. While some partners may choose to just invest their money, right, and don't work. You call those persons sleeping partners. All right. Now, partnership businesses still maintain final accounts, a set of final accounts. When we talk about final accounts, we are talking about income statement and we are talking about the statement of financial position, right? Right. But they must also add to the income statement or to the trading and profit and loss account, as some of you guys may know it as. They must add to that an appropriation account. So then, what is an appropriation account? Now, an appropriation account is an addition to the income statement that shows how profit and losses are shared in a partnership business. Remember, I told you that partnership business, right? And I told you to pay attention to the word shared because in a partnership business, right, the money have to share up, and that is what the appropriation account is for, to show you how the money or the profit is shared. All right. So let's look at the appropriation account, the format for the appropriation account. So this is what the appropriation account will look like. I want you to take note that you will have the heading. Now the heading is A and B. I have here for an example. These are two persons who are in partnership together. So we have the heading there, appropriation account for the year ending December 31, 2020. Now the appropriation account, as you can see, will start with the net profit, right? The net profit would be you would get the net profit from the income statement or from the profit and loss section of the income statement. And then we move on to add interest and drawings. Right now, you may wonder what is interest and drawings. So interest and drawings, right? It is money that is charged to partners to discourage partners from withdrawing too much money from the business. Because let's face it, you don't want your partners to be withdrawing too much money from the business. So you charge them interest on their drawings. It is a revenue to the business when they pay back with interest. And so you would add it to your net profit here. So you would add them in this column and then you put the total over here and then you add it to get this figure right here. All right. And then, as I said before, that some partners are active partners, which means that they work day to day in the business, right? So B here, he would get a salary because he is an active partner, right? So we would put salary there, we would subtract salary. We would also subtract interest and capital. Now, while interest is charged on drawings, right, interest is not charged on capital, interest is rather paid on capital. It's very important for you to make that distinction because interest is paid on capital to encourage partners to invest more money in the business, but interest is charged on drawings to discourage partners from withdrawing too much money from the business. And so you're going to be subtracting all of these items right here. So you would put them in the first column, you would add them up to get this total here, then you would subtract it from basically your your adjusted net profit figure, right? I would want to call this figure here adjusted net profit figure. Then you would get this figure, which is what we call the balance of profits, which is what is really left to share, right? So after you make all these adjustments to the net profit, then you get this figure, which is the balance of profits figure, which is the figure that you're going to be sharing up. All right. Now this is where it can get a little challenging, so to speak, but it's still simple. Now the share of profits is where CXC normally like to test your knowledge, right? So they will give you different what you call profit sharing ratios, right? Now that simply means how the money is shared up or how the profits are shared up. So you don't have to get flustered about it, right? So then they can give you the profit sharing ratio as a percentage, so it will be 50% of the balance of profit figure. They can give it to you as a fraction, right? So it would be like, say for example, half of whatever the balance of profits figure is right here, and they can give it to you as a ratio. So they can say 3 to 2, right, which would mean 3/5 of this balance of profit figure here, right? They can even give you the profit sharing ratio as a percentage of the investment of each partner. All right, I've seen them do that one time. So just pay attention to the profit sharing ratio here, right? And we are going to be doing a question in a little while. Now, after you share up the profits, right? After you share up the profits here, then you should get back the balance of profits here. So you do the share of profits in the first column, right? So A get X amount, B get X amount. Now when you add back these two figures, you are supposed to get the balance of profits figure, because guess what? This is the figure that you're sharing up. So after you share it up, it's supposed to come back to this figure. So this figure and this figure should be the same. That is why they are in red. And then you can put your double line there. And the appropriation account is finished. All right. Now, we need to talk about the current and the capital account, right? Now, the capital account shows each partner's contribution to the partnership, right? And this account does not change much. But then we have what is called a current account. The current account shows each partner's day-to-day dealings with the partnership. This account is kept current, right? Which means it changes a lot, because it takes into consideration each partner's day-to-day dealings with the business, right? And so you may be asked to show a capital account or a current account. Now, this is what a capital account would look like. The capital account, as I said before, it remains constant, and this form, right, is what we call the columnar form. Columnar form, right? The reason why it is called columnar form is because the partners are in columns here. So you have A in one column, partner B is in one column. So this is the debit side, this is the credit side over here. Obviously the debit side, right, would be for items that are decreasing the capital account, and the credit side would be for items that are increasing the capital account. So I hope you remember the principle as it relates to capital account. The capital account carries a credit balance, therefore to increase it you would make a credit entry. All right, so it's important that you remember that. So at the beginning, the opening balance in the capital account would be on the credit side, right? So you would just put that in there. So A's contribution was X, B's contribution was X, and that's basically how the capital account would look. It won't have a lot of items in it because it doesn't change a lot. It just shows you how much capital was invested by each partner, and we will look at it when we do a question. All right. And then look at the current account now. The current account has more information. It has more traffic, because it takes into consideration the day-to-day dealings of each partner. So this is also the columnar form. We could have done it another way, where we show each partner's account. It would look like a T account, right? So you would have A having a T account and B having a T account for themselves with the same information. It's easier to do it in the columnar form because it saves time, right? And it saves space. All right, so on the debit side of the current account, right, the current account also carries a credit balance, and what that means, one more time, is that to increase the current account you would make a credit entry, to decrease the current account you make a debit entry. Right, so the current account also carries a credit balance similarly to the capital account. Now on the debit side of the current account, right, you would realize that I have an opening balance. Now you would realize that I place it in red because that is not the norm. An account that carries credit balance, then the balance brought down should not be on the debit side, it should be on the credit side, right? So this is not the norm, right? And so the closing balance being on the credit side again is not the norm. All right, it is important for you to understand these concepts, right? So let's look at it. The opening balance on the credit side is the norm, right? And what it means is important. So it means that the business owes the partners money. So it means that the business owes partner A X and the partner B X, because this is the norm. The opening balance should be on the credit side in the current account because the account carries a credit balance. Now, as I said earlier, the opening balance being on the debit side is not a good thing. It is not the norm, and what it means is that if you look at the little bubble down here, what it means is that the partner owes the business money, which could have been as a result of the partner withdrawing too much money from the business. I have seen on questions where they ask that, so please pay attention to that. On the debit side of the current account, we have all the items that would decrease a partner's stake in the company, right, in the partnership, sorry. So we have drawings here and interest for drawings, right? And on the credit side, you would have all the things that would increase a partner's stake in the partnership. For example, you would have interest on capital, you would have share of profits, right? You would have salary. Now, in the example, in the example, A did not work in the business in the appropriation account, so you realize that he doesn't get a salary here. I want you to pay keen attention to the current account and look and realize that it resembles the appropriation account. Yeah, so the current account resembles the appropriation account. All right, so this is basically the partnership account. Partnership account is very easy, very simple, right? In my next video, I'm going to be doing a past paper question, so you don't want to miss it. Stay tuned, all right? Please remember to like, subscribe, and share. See you in the next video.